Hello, welcome back to another video on accounting. Today, in this video, we're going to talk about bank reconciliations in Chapter 10, cash controls and bank reconciliations. The main two topics of this chapter are bank rec and petty cash. It's an easy chapter. The bank reconciliation is what we do is, our bank rec, you may hear, is that we compare what we have on the bank statement from the bank to what we have on our cash GL. Both should match, but oftentimes it will not. And it will not for these several reasons. For instance, with the cash GL, what we have in the cash GL that is not in the bank statement has to be added to the bank statement. And what's in the bank statement that's not in the cash GL, we have to add to the GL. But we don't just add it, we have to do JEs, or journal entries, to add them back into the GL. Remember that our JEs are posted to the GL, so we don't do anything directly to the GL, it comes through the entries. So I'm going to do the entries in the center. When it comes to the bank statement, though, we don't do anything with the bank statement. It's just we do a separate document, actually. It's not an entry, it's not a JE, it's not a GL, no financial statement, it's not a TB. What we're doing is we're just comparing the two and then making entries to fix it so they will balance. And the very first thing you start off with on both sides is the ending balance. So what was the balance of the GL, and what is the statement balance at the end of the month? That's the very first thing you want to say. What is the ending balance? You start off with that. Then we compare item to items. And in the cash GL, when you write a check, you put it immediately, you credit the cash GL, but it may not have cleared the bank. So we call that outstanding checks. I'm going to put it OS checks. And that gets subtracted out of the bank balance because the bank hasn't received the check to clear the bank, but it already has credited or reduced our cash balance. We may receive deposits directly into the office, not just cash, maybe cash, or any other checks that are coming in for paying receivables. Those checks may be received and posted to the GL because they were received on the end of the month. But the bank has a cutoff, and usually banks have a cutoff of 3 o'clock that day. Any transaction that happens before 3 o'clock will be considered same day. After 3 o'clock will be considered the next business day. So if we have a deposit that we did on the 30th of April, but the person who goes to the bank doesn't get there till after 3 o'clock, but the bank closes at 5, so of course the bank's open, but after 3 o'clock it's considered the next day. So these would be deposits what's called deposits in transit, and that would be added to the bank statement to balance this because we debited the GL to show the incoming cash and other cash equivalents deposit. Well, okay, so we have outstanding checks. What would we do with the cash balance, the cash GL? Well, if there was any interest, that would be added. See, it's all, won't notice that my green is the added parts. And what if there was any fees? Fees would be subtracted out. That would be bank having charged a fee that we didn't know about. Also, any other deposits or ACH/wire deposits. These would be any electronic deposit that a customer would have initiated and may not have told us. And if we didn't know about it until we got the statement, it would be in the statement, but it wouldn't be in the cash GL, so we would add that in. Also, what if someone made a bookkeeping error on our end, which is the cash GL end? That would be added or subtracted, meaning that the bookkeeper wrote a check that we received was for $100 and it should have been $10. That's a bookkeeping error. So I'll write that in green, but I'll put parentheses around it in red because it could be either added or subtracted. It would only be noticed when the check comes back, whether we wrote a check or we receive the check and we notice that deposits are short by $90 because we made a bookkeeping error. So I'll write bookkeeping error here. And like I said, I'm going to put, so it could either be added or subtracted. Also the same thing with bank errors. Could be either added, subtracted the bank statement because we know we're correct. If it was a bank error, we're correct, the statement is wrong. If we made the error, the statement is right and our GL is wrong, so we'll have to make an adjustment for it. What if a customer paid us in a check, but unfortunately didn't have enough money to pay for it? So it was a deposit that actually showed up both in the statement and the GL when we actually deposited it. But a couple of days later, we're notified by the bank, and the bank will immediately do that. We'll debit or reduce, subtract out of our balance that check. So an NSF check will show up in the bank statement, but will not show up here. So this would be an NSF, which stands for non-sufficient funds. Would be subtracted out of the cash GL because we've already debited the GL for that deposit originally, and now we have to credit it because that check didn't happen. That deposit didn't happen. And lastly, and these are general, lastly, what we have to think about is what if there's any monies that are electronically withdrawn from our bank that we don't know about? So actually, I'm going to write here, included in ACH wire deposits from customers / withdrawals because withdrawals would be credits to our cash. Deposits would be debits to our cash. If we didn't know about it, we only are aware of it because of the bank statement. So that is a bank reconciliation in a nutshell. So now let's do a transaction. Let us do one as an example from the book. Okay, so let's go to our book and turn to page 374. And we're going to do exercise 10-2, and we're going to do a bank reconciliation right here. Easy. As you can see on the top, on page 374, on the top half is the cash GL, and on the bottom half is the bank statement. So what is the first thing we do is we write down, the first thing we do is write down the two balances. So what is the ending balance of the GL? The ending balance or closing balance is $48.15. And the closing balance of the statement says $2,000. Already we know we're not in sync because we're saying in our books that we have $48.15 of cash, that's a debit balance, and the bank says there's only $2,000 in the bank. Why? Well, what we should do is we go through every line from bank to GL or GL to bank and see what are the differences. So we don't look at the opening balance. Do we have a check number 541 that was deposited on June 6th in the GL? Yes, 950. Check, check. We don't have to do anything with that. We have a debit to our GL, which is incoming money from REO Interiors for 1925. Do we have a deposit in that amount? Yes, 1925 June 9th. Check, check. We have a check that we sent out for check number 543 for 1600. Do we have that in the bank? 1600 in the bank. Check, check. We have check number 542 in the GL for $400. Is that in the bank? Yes, it is. Check, check. We have an incoming check that we received for $2,000 on June 16th. Is that in the bank? On the 16th, there is a deposit of $2,000. Check, check. On June 19th, we have check number 544 in the amount of $110. Is that in the bank? Yes, check, check. Check number 545 is for $500 on the 19th. Is that in the bank? No. So we have an outstanding check that's in the GL, but not in the bank. So we have to subtract it out of our bank balance. So that check number is 545 for $500. So we have to take it out of this balance of $500 because it's in the 4815. It's not here. So we have to, that's check number. We can write that down. Check number 545. Continue. We have a debit incoming money from Eric Draven for $1,300. Is that in the bank? No. That's an outstanding deposit. So we need to add that back into the bank balance because it's in that 4815. So I'm going to use blue this time. Line for deductions and blue for additions. We have to add that in, so that's an additional $1,300, which is the outstanding deposit. The next thing we have is, that's the last thing. We have the closing balance as of June 30th, which is the 4815. Okay. We are done with the bank statement side and reconciling the bank statement to the GL. Now we need to reconcile the GL to the bank statement. And let's do the same thing over again from the top. The first thing is that there's a bank balance, so don't worry about that. Check 541 for $950. Is that in the GL? Yes, check, check. There's a deposit on the 9th for $1925. Is that in the GL? On the 9th, $1925. Check, check. We have a check 543 in the amount of $1,600. Is that in the GL? Yes, check, check. We have a deposit of $2,000. That's on the 16th. That's equivalent to the check, that debit of $2,000. So check, check. We have a check number of 542 for an amount of $400. Is that in the GL? Yes, check, check. We have an NSF check here. That means that we had a check that hit the bank that was non-sufficient funds. It was originally deposited. It's now being withdrawn from the bank, and we have that in that number. So we have to take it out of the number. We have to credit the GL in the amount of $2,000. I'm going to put NSF here for NSF check. And the next thing here is that there was an NSF charge. That's a fee. That's a bank fee. So they took $6 out of our account. We need to take that out of our GL. So I'm going to put that as NSF fee. We are charged because the bank had to pay back that money that we originally gave them. They had to give it back to their bank because the check was no good. And so we were charged an NSF fee. The next item here is a check number 544 in 110. Is that in the GL? Check, check. The last item here is a service charge of $14. That is being taken out of the bank. Out of the bank statement, but it's not in here. So we have to take it out of this side. And I'm going to put it as SERV fee for service fee. Now we add and subtract, and we should have the same balance. There was one more transaction that I missed in the bank statement that is not in the GL, and that was there was $5 of interest that was posted, and that was not in here. So that's $5 of interest that we have to add. So what happens when we add and subtract over here? 2,000 minus 500 plus 1,300 becomes 2,800. What happens when we add and subtract over here? Well, we have 2,020. 2,020 minus 5 is 2,015. That becomes 2,015 minus 4,815 is 2,800. And are we in balance? Yes. Boom! Now, what we need to do is we don't do anything on this side because the bank is responsible for the bank statement. So we don't do anything on the statement itself. But what we do need to do is the cash GL still says there's 4,815 should be in the bank. 4,815 should be in the bank. It's not. We balanced it, but we balanced it because we had to add and subtract things that we found on the bank that is not in the GL. So when it comes to our own GL, what we must do is we must do JEs. So let's do a JE for each one of these. And this is part of the adjusting or the adjustments we do at the end of the month. So we should do bank reconciliations and do it early enough in the month so that we can post it for the previous month so we can keep it in balance. So the very first item we found is we have a $2,000 NSF check. This NSF check, this check what we received from a customer bounced. It bounced because the customer didn't have the money. So where is it that when customers make payments, why would they be making payments to us? It's because of the receivables. So this means that accounts receivable is wrong. It is overstated because now we know we didn't get as much money as we thought we did. So we have to debit AR for $2,000 and credit cash because this cash, we have to take it out of the GL because the GL is overstated. So that 2,000 is going to be here. The next item is we have an NSF fee. We were charged a fee. So I would say we could use bank fee as a generic term. I would use NSF fee. I don't have any problem either way as long as you're consistent. So I'm going to put it's an expense. So we're going to debit $6 from the NSF fee and credit cash because it came out of cash. The fourth piece is that we have a service fee of $14. So I would debit service fees, another expense for $14, and credit cash. And the last thing is we had interest. And I'm going to put it up here because I'm running out of room. But we had interest. So that's income. That came in. So that's interest income. So we credit interest income. That's money that came into the cash. So cash increased by $5. So if it's an increase in an asset, it's a debit. So we're going to debit cash and credit interest income for $5. Are we in balance? We're still in balance. We do not, and I repeat it again most emphatically, we do not do anything with what we've done as an adjustment over here. These adjustments to the bank statement do not have anything to do with our GL. These are things that were in the GL that we knew about, and it was part of the 4815. So we don't need to do anything over here. This is just a working paper. It's just as a spreadsheet, this column and this column, to make sure we know what to add and what to subtract out of each side to balance it out. Now that it's balanced, that we've accommodated for all items, then we do our JEs, and these are our JEs. To address the fact that the cash GL was out of sync with the bank statement. So it's now closer to being in sync. We still have this outstanding check that we wrote that hasn't cleared. That's fine. And this deposit that we did is in this number. So the only thing that really is outstanding here is that check hasn't cleared. And it will clear. It will clear. It just hasn't happened yet. The last thing we're going to talk about in this chapter is petty cash. What is petty cash? Well, petty cash is that little bit of cash that's in the office itself that is used for incidentals, small incidentals, like, oh no, we have to buy a birthday card for the president of the company because we forgot his birthday. Oh dear, what are we going to do? Well, are we going to actually go through AP and try to generate some sort of voucher or some bill to get that and to get the cash, and then go to the bank, write a check, go to the bank, cash that check for $2 or $5, go to the bank, wait in line, cash the check that's written to an employee, and then make it to the store and back before the president leaves for that afternoon tea time? No, that's kind of ridiculous. Or, oh no, we forgot it's the monthly birthday party. We need to buy birthday cake for everybody whose birthday is in January. We need to get cake. So how are we going to get that? Well, someone's got to go out and buy it. Well, I'm not going to buy it. I don't have any cash on me. Well, let's go to petty cash and take some money. We take the money and bring back the receipt. That's how we reconcile petty cash. Very similar to our bank reconciliation. We get a receipt. We bring the receipt back saying, here's how much I spent. Now, the problem with petty cash, it is small bills. $200, maybe $1,000 in petty cash, depending on the size of the organization. And if they're going to spend that much in small amounts, then you know that they're spending much more on bigger fish. So $1,000 or less is a small fish to fry. So yes, we reconcile to it, but we kind of ignore, and I'm going to say it in a very light way, ignore any overs or shorts. It's somebody kept the change, there's 50 cents here, 25 cents here, adds up to $2. We have $1,000 petty cash and we're off by $2. No big deal, we'll just write it off. That's how we kind of handle it. We have an account for that handling of the write-off. It's called the over and short. So cash over and short, and that actually gets adjusted to our cash later. Petty cash is also adjusted to cash, but it's a small separate cash GL that we set up just for the incidentals in the organization, incidentals in the business. Sometimes it could be postage. Somebody went out and got coffee for the office. All 7 people wanted coffee at once. So they sent the intern out. The intern is not supposed to pay for it. The organization should, because everybody got it. So they take it out of petty cash. Here, intern, here's your $10, 20 bucks, whatever, for all the coffee you bought us. So we're going to do some transactions based on the book again. So I can give you an example. So the example I have is exercise 10.3, which is found on page 376. I'm going to read it to you, which I know you can read, so I'll read it anyway. On April 1st, 2018, Clayton Company established a petty cash fund of $200. During the month, the custodian, who is the one who monitors and handles the lockbox, which is the petty cash and has the key, placed the following receipts in the petty cash box. April 6th, paid $40 for postage. April 8th, paid $20 to FedEx for delivery of a package. April 10th, paid $25 for travel expenses for an employee on company business. April 14th, paid $8 for coffee and donuts for a client meeting. April 15th, paid $7 for paper for the copier. The custodian counted the funds on April 16th and found $95 in the petty cash box. First we need to do is do a JE to establish the fund, and then do a JE for all the transactions and the amount that we have to take back out of cash to refund petty cash to bring it back up to 200. So, first things first. Let us first, on April 1st, so your transaction on 4/1 would be to debit petty cash and credit cash for $200. And this is how we set it up. On April 16th, the custodian, the one who handles the petty cash, counted all the receipts. So let me mark all the receipts down. We have, all the transactions is going to happen on April 16th. And this is how we're going to replenish this $200. We have postage expense. Debit of $40. We have FedEx, which is delivery expense, or freight. But I'll put FedEx in here, it will be an expense of $20. Then we have travel expense for $25. Then we have entertainment, we'll call it an entertainment expense. The coffee and donuts for $8. We're entertaining the client. And then paper expense, or photocopy, it's paper for the photocopier, $7. And then we're going to credit cash because we have to take it out of cash to replenish the petty cash. I'll put that a little lower. How much? Well, we know that we have $95 in there now. So we have to put back into the petty cash $105 to bring it back to $200. But when we add this together, what do we get? We get 60, 70, 80, 85, 85 and 15 is 100. So this equals 100 by the receipts, but we need 105. So that means that we have to have another $5 out of where? We don't have an expense for it because we don't have a receipt. This is the over and short. So we'll have to debit the over and short to get us back to the 105, which will equal the one. We add that to the 95 that we found in the box. It says that the custodian counted the funds and found 95 in petty cash. And that would be our transaction on the 16th to balance it out. Now we're going to make a huge jump from chapter 10 to chapter 15. We're not skipping the chapters in between, but we're going to make another video separate for those. There are a little bit more difficult, challenging issues in those. But I felt chapter 10 was pretty easy, talking about bank rec and petty cash, very simple concepts. And now we're going to go into talking about corporations and stock, and specifically stock. So a corporation, we talked broadly about that earlier. Now I'm going to be a little more specific about the pros and cons of a corporation. A corporation is has separate legal existence from its owners or stockholders. Think back to Henry Ford, who started Ford Company over 100 years ago. Is he still alive? No, but Ford still exists as a company. It is beyond, it has a separate legal existence. And so the people, stockholders of AT&T are not AT&T, are not named AT&T, unless maybe there might be a stockholder whose name is Anthony Thomas Turney. That might be one stockholder who is named after the company and has the same name. But in reality, the probability is probably unlikely. So it's a separate legal. The limited liability I mentioned before, that anything the corporation does, since it is a separate legal existence, it's a separate legal entity. And so anything that it does is independent of the owners. And so any liability that the corporation is responsible for is limited to the stockholders. There is in a corporation, especially C corporations, there's a formal organizational chart. There is a CEO, there's a C-levels, EVPs, VPs, managers, supervisors, line people. There's a formal organization of the firm, of the corporation. It has an unlimited life. Ford, like I just said, is over 100 years old, actually, and it could continue. There's nothing stopping it. The only thing stopping a corporation from existing would be some exogenous variable that would cause it. Something in the marketplace that says we don't want your product anymore, and they file bankruptcy, and sales or revenue go down. Or some law is enacted, which is the government would say whatever the corporation does is now illegal, so you have to go out of business. All these other many reasons why a corporation would go out of business, but intrinsically, there is no reason why, if the corporation is able to sustain itself, that sustainability is not unlimited. It's got an ability to raise its own capital, and that means it can sell stock. And that's what we're going to talk about a little bit. Now, those are the positives. The negatives are the tax treatment. When the income, remember the multi-step income statement at the bottom, just at the bottom, after taxes are taken out, there's net income. Now, what happens is that net income is distributed between the company itself, called retained earnings, and paid as dividend. If it's paid as a dividend, it's paid before it's retained, so a portion of that is paid to the shareholders. When the shareholders receive that dividend check, it's considered income to the shareholders. That has already been taxed money at the corporate level. The corporation paid tax on that money. It was already paid, and now we're paying it again. That's the double taxation that we talk about with corporations. So there's a tax charged to corporations that they have to pay for their income or revenue at the end, and then that portion of revenue or income, net income, that they distribute to shareholders, it's charged at the shareholders' tax rate again. And the government requirements, the government, state government usually, requires a filing of articles of incorporation, financial statements. The publicly traded companies are required to provide this information every quarter. So there's government requirements and other legal requirements to establish the organization, and to ensure its maintenance, it must be filed with the government. So that's a little overview of our definition of corporation. So what are we talking about when we talk about this capital? This capital is right here. When a corporation's raising capital, it's part of the owner's equity. But in a corporation, we don't call it capital necessarily. We call it stock. So this stock can be considered common and preferred. Those are two different and special classes of stock. Generally, when you're thinking about the stock market, we're talking common stock. Preferred stock has its own characteristics I'll go into in a little bit. So both are listed in the owner's equity section as a par value. What is par value? Par value is a nominal value, maybe $1 or less, that the stock is listed in the stock section of the equity portion as a nominal amount, just to count it. And anything paid above that is called paid in capital. I threw in Treasury. We'll talk about Treasury a little more in this chapter. And the other section of the owner's equity, which is stock, is retained earnings. And that is the plowback of net income over time after dividends. Now, when it comes to stock, whether it's common or preferred, we have three subclasses or three definitions of what kind of stock, what that stock is. When the board of directors say, yes, we want to sell stock, and we want to sell a number of shares of stock because the shares will equal how much money we want. So we want X amount of money, we're going to divide that into shares and then sell each share out at a certain price. And that is the number of shares they're willing to sell is called an authorized shares. Now, authorized shares is what they're willing to sell. What actually gets sold is a different number. That is issued. So they say we would like to have 1 million shares, but we're only going to sell out, we only sell out 500,000. So 500,000 shares are issued. And that usually is what's outstanding. Outstanding means what is actually in the marketplace. So if you issue 500,000 shares and people buy the shares, that means that you also have 500,000 shares in the marketplace. The trick is that the difference between these two amounts will definitely be different than the authorized. The authorized is usually a larger number than the issued and outstanding. Issued and outstanding are usually the same number, except when it comes to treasury stock. Treasury stock is when a corporation buys back its stock from the marketplace, not from any individual stockholder, but it's going to pay market price. When it buys it back, it increases this, which is usually a negative, meaning it's a treasury, it reduces the stock because the stock here is counting what has been issued and outstanding, but when we have a treasury, it's no longer outstanding. For instance, we authorized 1 million shares, but we issued 500,000, and there's 500,000 outstanding. But this corporation decides to buy 250,000 back, which then changes this outstanding to 250, because 250,000 of this 500,000 is in the hands of other people. 250,000 shares is in treasury, and that's where we will find it when we reconcile these numbers. Well, let's look now on some commonalities and differences. What is the difference between a common stock and a preferred stock? It has anything to do with position. It doesn't have anything to do with income. It has something to do with how many shares there really are. So common stock, just like preferred stock, is a symbol or a proportion of ownership. It's a piece of paper. It's a document that lists what proportion or what number of shares is equivalent to the ownership by that shareholder. Common stockholders have voting rights. They can vote in board members. They can vote on major company policies. And at the shareholders meeting, if you're a shareholder and you can make it, go to the shareholders meeting, because there are some interesting things you might find there. I'm not entirely positive if you'd be that interested. I would be interested because I'm a finance guy, remember? I'm not an accountant. Common stockholders are what's called residual claimants. if in the event of a bankruptcy and the company must liquidate its assets to pay its liabilities, whatever is left over, or maybe I should say it more like this. In a bankruptcy, the corporation must sell all its assets to satisfy all its debts. And the first one that gets satisfied is what's called senior secured debt. Then you have junior and subordinated debt. Then you have unsecured debtors. So you have senior secured debtors, you have junior or subordinated debtors, they're all secured, and then you have your unsecured debtors at the next piece, and then what's left over is what's available for all stockholders, whether it's a common stockholder or the preferred stockholder. But preferred stockholders get a piece of it first based on what's left over, if there's anything left over, their proportion of ownership. So that percentage of number of shares they have of the equity, that's how much they're going to get, and they are above common. So the last morsel, if there's any morsels left, is the common stockholders. So their investment may pay back at that point. It may not. They may lose their money and the company goes bankrupt. And they may get dividends. Dividends are not absolutely guaranteed to common stockholders. If it's declared, and it's declared that they're going to have dividends, the preferred stockholders' dividends are always coming first. Always come first. And then, if there's anything left over after declaring that dividend, then that amount is divided by all the common shareholders, and they get what's left over, again, as a residual claimant. But that's a dividend. Now, the difference here is that preferred stockholders, like I said, are residual claimants above the common stockholders. They get paid their dividend first. Now, it could be a cumulative preferred stock or a non-cumulative preferred stock. A cumulative preferred stock means that if the company does not declare a dividend in 1 year, neither get paid. But if it's a cumulative preferred stock, then in the next year when they do declare a dividend and pay it, the preferred stockholders that are cumulative will get last year's dividend and this year's dividend. And if there's anything left over, then the common stockholders will get what's left over, if anything. Most often not. So they will receive it. A non-cumulative is the same as a common stockholder in that a non-cumulative preferred stockholder does not get previous year's unpaid dividend. So if 2018 the company does not declare a dividend, and 2019 they do, the non-cumulative will only get a dividend because of 19. The cumulative would have gotten 18 and 19, so they get double paid. There's also preferred, not in the book, but there is a convertible and a non-convertible preferred stockholder. A convertible preferred stock means that the stockholder can, at their option or the option of the corporation, usually it's a corporation, to redeem those stocks and convert them into notes or loans, long-term notes. So there would be a definitive due date for when that preferred stockholder would be paid. So they would take all the amount that's in the preferred stockholder bucket, or GL, and take all that and make it into a loan. It's going to stay on the same side of the equal sign, so it goes from equity to liability, so it doesn't really change the balance. It stays in balance. But then there's that equity goes down because now liabilities have gone up. It still has to balance. To non-convertible would be that they are not. Now, to calculate the preferred stock dividend, this dividend right here, it's the par value times the number of shares outstanding of preferred stock, which is always going to be the issued, times that percent of the dividend percentage. If it's a flat dollar amount per share, then it's multiplied by that dollar amount. But if it's a percent, and usually it's a percent, it would read something like 100,000 shares of $2, 6%, $2 par. And that would be the listing for preferred stock. That 2% is the dividend percentage, and the $6 par is that par value. Common stock is usually listed as $1 or less in par value. Preferred stockholders are much larger. Now we're going to get into the next thing we're going to talk about is issuing stock, and how do we account the JEs for issuing stock and the JEs for the dividends. Okay, what we're going to do is we're going to issue stock because we need some money. We need some big money. Not a little piddly amount of money we get through revenue or selling some product. We want some big money. So we're talking about raising capital. That's big money. That's called a capital infusion. And how do we do that? Well, what we're going to do is we're going to issue stock to do that. So we want $260,000. And to do that, we're going to issue 1,000 shares of common stock with a $10 par. I know I said that par is usually $1 or less, but this is the example I pulled out of the book. And 5,000 shares of preferred stock at $50 par, and it's a 6% dividend. And we want to raise $260,000. So how do we account for it? Again, this is a JE. So we're going to get cash in. And so the amount of cash in, that's our debit, is $260,000. I'm going to write the whole number out so you can see it. So what do we credit? Well, we credit common stock and preferred stock. But we only can do the common stock and preferred stock at par. So 10 times 1,000 is 10,000. So that's $10,000 here. And this is 50 times 5, which is 25,000. I'm sorry, 250,000. I decimal the wrong place. Are we in balance? We have 260 over here, 250 plus 10, 260. We're in balance. What if we were to change this a little bit? And instead of 260, we are going to raise 280. So I'm going to change this to 280. And change this to 280. Just like that. Are we in balance now? No. We received 280,000, but we have 260 over here. How do we get in balance? Well, we need an additional 30,000 over here, right? Now this is in balance, but what account are we going to use? That is the paid in capital. Or PIK. I will start saying the word PIK for this. So you're going to use the PIK. That means you're going to use paid in capital. The full name of that account is actually paid in capital in excess of par. Now, these stockholders are going to get some dividend. So we're going to declare a dividend for $300,000. That $300,000 has got to be divided between the preferred stockholders that get their dividend first, and anything left over is going to be divided by the number of shareholders we have, common shareholders we have. So, how do we figure the dividend for preferred? It's the number of shares outstanding times the par value times the percentage or times the flat dollar amount. This is a percentage. So that's 250,000 times 6%, which gives us which equals preferred stockholders equals, the dividend equals 15,000. So we take 300,000, which is the total amount of dividends we're declaring, and we subtract out 15, which is what we're going to pay the preferred stockholders en masse. That's going to be divided by how many shares we have. So we have 5,000 shares, $15,000. That's going to be $3 per share. And the remaining is going to be divided by the number of shares outstanding for common. We have 1,000 shares outstanding. So 285 divided by 1,000 gives us $285 per common stockholder. How do we write that? Because we're going to pay it. Now we're paying it, so we actually credit cash for it. We have to debit something. It's expense. When we do a dividend, it's an expense, just like any other expense, but it's outside of the income statement. It's kind of separate. So we're going to debit the preferred dividend expense, which is 15,000. We're going to debit the common dividend expense, which is 285. And we're left with 300,000 that we're going to credit cash to pay it. Now here's a different situation. I'm going to back up a little bit here. What if we issued or gave stock in exchange for something other than cash? What if we bought land with stock, or we paid for services with common stock? Well, it's really the same. This part of it, these credits are going to be the same. What's different is this account right here. So let's pretend instead of $280,000, we're going to issue common stock, to pay for land in the amount of $150,000. So we're going to buy land. So land being a fixed asset increases by $150,000. It's the same par value. So how many shares is that? Well, if we issue it at shares, at a par, then it's $10 a piece, so we're going to issue 15,000 shares. There is no paid-in capital here. Nobody paid money, so there is no PIK. The PIK is only because this was cash, and it was in excess of par. This is going to be issued at par. It's because it's a swap of non-cash for non-cash, common stock to land. And so that because we're not paying any money with cash, there's nothing over that. So when we're issuing stock to pay for non-cash items, we can just debit that non-cash item and credit at par. And that is pretty much the end of chapter 15.